Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you haven't. And just a little disclaimer, nothing should be construed as financial investment advice. Just my opinions, thoughts on the market. You can read more disclaimers below. Let's get into today's stuff. I haven't been able to do much this week, but if you look at it, Monday was nothing, just auctions. Look at this, used car prices have been going up. And I think part of that is inflation, I guess. I would say maybe also some, with the tariffs and everything, and they can afford to raise prices, I guess. Consumer inflation expectations, those were less than expected. Uh, Mortgage rates, they're not really all that. What caught my eye was wholesale inventories. That's down 3%. That was around the consensus. A lot of people front run the tariffs, so I'm not. This is the first decrease since December of 2024. But look at computer equipment, durables, furniture, professional equipment. So look at this, higher stocks of petroleum, alcohol. So I'm not sure. I think it's just people front run and people are now just liquidating inventory. They're trying to get rid of it because they know if you look at the last retail sales number, it's not doing well. So let's see. These are things I just thought were interesting. This generally means a top, but you never know. It could be roaring kidding. Retail investors have gone beyond the 2021 meme stock frenzy, bought 155 billion worth of U.S. equities in the first half of 2025, the most in a semi-annual period. So if you look at it, beats 2024, any of those things. If you actually look at it, the most was in 2022. So 2019, then by much 2020 was not a good year for the stock market. So I don't know how much this is as a contrarian indicator. But generally, when retail, they're generally the last, what they say, but I don't know this time. So, but yeah, retail investors, think what you like. I just thought this was interesting because CNBC, they're starting to sound like all those gloom and doom channels. Declining dollar. I'm so sick of hearing about the declining dollar. I just don't listen to anyone, but worst half return in 52 years. I don't think that really matters with gold. Uh, we've seen gold go up when the dollar goes up and gold go down when the dollar goes down. It's just a measure against foreign currencies. And let's see what is I think it's the Dixie, the XY, uh, dollar index. I think it's the Dixie. Let's see. Yahoo. Yeah, it is the Dixie Dollar Index. Yahoo, Google Finance just stinks. So let's look at, yeah, the dollar index 97. Whoa, I thought it was like 108 at one point. I don't, as you can tell, I don't follow the dollar index. Look at that. In 1990, it was around 157, but let's do a 5 year. But if you look at it since 2000, the low was 72 since 2011, gone up. 2016 declined some, 2020, but through 2020 all the way through 2022, the dollar went on a big run, and this was with gold. and dollar went up here, that gold went up, so I don't think it matters per se as much. Uh, that's what I think, but I thought it was just interesting. They sound like gloom and doom. But here's another leading indicator, and this is why I think the Fed will eventually cut rates. U.S. private sector employment's in recession, and if you look at it, this is interesting because all the jobs. I always say these weren't but they were all driven. Private payrolls, 74,000 jobs, least since October of 2024, all driven by healthcare, which is basically government, subsidies of government. So it's not really like you look at it, market-based jobs, the US, they're down. And the ADP role was correct. So, I mean, if they had an honest jobs number, they would just report the ADP under the private sector employment, and that would be take away 74,000 jobs from the headline number 74,000 73. So it'd be like 73,000 jobs. Let's see if I got that right on my head. 73,000 times 2. Yeah, it's 74,000. So anyway, that's I thought that was just interesting. And then speaking of home ownership, growing number of homeowners who bought in pandemic boom towns now owe more than homes are worth. To me, this is a leading indicator. Remember, it starts in the weakest of areas, then spreads. And so look at this, Austin, Texas, Cape Coral, Florida. They're underwater now. So what, sometimes like in the '08 housing bubble, they just walked away from it, turned in the keys and defaulted. I don't know if that's going to happen per se, but it's very possible. People get drowned up in debt, they might just do that. So and this is the other thing, condo prices making record slide as crisis hit breaking point. So average condo sale price fell 2.2%. Second largest drop dating back to 2012. So a lot of these biggest condo prices, Florida and Texas, I've talked about that. This is look at this, Houston, Texas down 23%. I have family there. Tampa, Florida down 19, Oakland down 20. So yeah, if you see it, they're so hyper focused on single family homes, but this will eventually start coming to single family homes. It's not gonna just only go to condos. So look at it. It's a slow housing market across the board, but condos have been hit particularly hard, says Redfin agent of Boston. So there it is. They don't allow buyers with FHA loans. Uh, so yeah, yeah, condos. I think it's a leading indicator. And what else I think is interesting to show that this retail sales number was no fluke is Prime Day. Sales off 41% first day. So you can tell Prime Day is not a success. It's not doing well. Expanding it from to 4 days from two, giving extensions more shoppers more time to navigate, but the preliminary results are grim. So there you go. So yeah, you can tell right now. Let's see, it says nothing. There's no real. They say because shoppers indicate they wanted more time to navigate the deals. I don't buy that. they need more time to navigate the deals because they're hoping to come up with more money, come up with some money. So, but they can't afford them, even with the deals. Focused on dish soap, protein, staples, TV, gaming. So yeah, you look at it, it's not doing well. So yeah, they're having trouble. So yeah, if you look at it, I don't, in terms of long term stock market, I mean, it's probably going to be up for this year, or at least sideways. I mean, they're hyper focused on tariffs. The stuff I talk about that's happening has not hit the market narrative. I was listening to something, and I don't like this person per se, and I don't have anything good to say about him, so I'm not going to say who it was. But one thing I did agree with, and this just showed up in one of my feeds. Long story short, so I listened, and he said, what controls the stock market more than anything, more than technical analysis, fundamental, is narrative. And if you look at it, the only reason that 2023 really came up is there was some okay data, but it was off AI hype. And then when Trump became in office, there was a big sell off. There was Trumphoria, AI hype, and Trumphoria. And then what happened was they were worried about tariffs, and that's what did the sell off. And then when Taco came out, I think you all know what it is. The stock market kept coming up. Pretty soon, though, if you look at the mainstream media with housing, look at narrative. The reason prices haven't come down yet is there's still this whole narrative of low inventory, low inventory. Now they're sort of conceding that narrative, but they're just saying, oh, no, the only problem is mortgage interest rates. And sometimes it takes a while before a narrative. I remember I was looking up something today, and it was just talked about, and I think it was like home prices 2006. Everyone remembers the real crisis was 2008. But the thing is, 2006, the market was undergoing a significant shift, transitioning period of rapid growth and appreciation to a more uncertain, in some cases, declining market. Prices generally peaked the first half of the year with subsequent slowdown decline later half into 2007. The crash is known for '08, but it started in '06. And look at this. Real GDP grew 3.4%. That was 3.4%. But looking at this, I was looking at these. They peaked in 2006. There was something interesting where it said home prices are declining. And maybe it didn't happen, but let's see, 2000 and let's do 2005. Average home price 305,900. Let's see what average home price in 2005 was. So the average home price was 29,297,000. So it did go up in 2006. And yeah, the average house sale price was 305. You look at it, we're way above 450, 2008 levels below. And look at this. New home sales dropped by a record. Meanwhile, prices were still big. New home sales are a leading indicator. And anything I was hearing, but when I Googled home prices 2006, last time I got all this bad news. But as you can see, it didn't hit the prices yet. And if you look at it, that's sort of what we're hearing now. Pending home sales aren't great. New home sales aren't great. And all that other stuff. And now I think it's a matter of time. But right now, narrative has to, I think all the good narratives that are not true because it's a bad market have to be wiped out. And you're starting to see home prices slash. Let me just do the chat GPT. I do think home prices do have to, are housing slashing on new homes in 2025. I'm going to ask ChatGPT. I'm almost sure they are, but let's see what ChatGPT says. Look at this. As early as 2025, home prices have been showing some signs of softening. So I don't know. I meant to do inventory or home builder, but if you look at it and then just it goes down, and I think that was happening. You look at '08, new home sales, pending, all that was bad in '06, but the prices didn't really come till a couple of years later. And I think that's what it was. And I think I remember in 2008, there was a big argument, Ben Stein, Peter Schiff, subprime's a tiny blimp, but it's only a tiny blimp. I think there will be rate cuts though, and I think that will create more inventory. I think more people will sell because of the rates now, and I don't think there'll be much buying. So, because the problem with most people's prices, it's not rates, and that's number one. In terms of gold, I still think we're in correction mode. The good thing is like you see a bad day and like it's being bought and it's not lasting all that much, but I think we're sort of more in a consolidation phase. You're starting to see M&A heat up. Like I'm getting all these emails now about some of my companies I own are buying companies I already own. So my portfolio looks weird. So I don't know the whole value because so much is like, this is not, this is still in, this is still in, this is still in. So I haven't been able to look at my mining portfolio in full. I can't wait to do so, but I think lower rates are sort of coming, and that will be the blow off top in gold. And I think that's coming sometime later this year and early into next year. So yeah, that's just what I think of the markets. Hit that like button if you haven't subscribed, and remember the disclaimers. This is not financial investment advice, it's just my opinion. If you do want to research, if you want to invest, consult a professional advisor and consult different opinions too. So, all right, I'll see you next video.